Right now, as of 12:16 p.m. Eastern Time on October 23, 2025, Tilray Brands, ticker TLRY, is trading at $1.50 per share. That is up 3.5% for the day, or about 5 cents, on already heavy volume of over 28 million shares. The stock gapped up at the open, starting the session at $1.44 after closing yesterday at $1.45, and it has been pushing higher, hitting $1.54 just a short while ago. So on the surface, this looks like solid bullish momentum, likely a continuation of the enthusiasm from that surprise earnings report a couple of weeks ago. But the real story in the data right now isn't just this intraday green candle. It is something much more specific happening under the surface. While everyone is focused on the income statement, the plumbing of the market is showing signs of stress, specifically the failed-to-deliver data. At the end of September, the most recent data we have, Tilray saw a sudden, massive spike in fails-to-deliver, or FTDs. We are talking about nearly 8 million shares that failed to be delivered on a single day, September 30th. This was valued at over $14 million. To put that in perspective, the days leading up to it were almost zero. This is a signal that a massive number of shares were sold, but the seller could not locate the shares to deliver them, a hallmark of certain types of short-selling activity and settlement system stress. Now, let's establish the common ground, the main story that has every Tilray investor feeling optimistic for the first time in a while. That was the first quarter fiscal 2026 earnings report on October 9th. It was, by all accounts, a blockbuster beat. The expectation for Tilray, built up over years of losses and dilution, is that it's a cash-burning cannabis company waiting for U.S. legalization. The reality that day was completely different. The company posted a record first-quarter revenue of nearly $210 million. More importantly, they reported a surprise net income of $1.5 million, a profit. It may sound small, but going from a $35 million loss in the same quarter last year to any positive number is a significant event. Earnings per share came in at 0, flat, which handily beat analyst forecasts for another loss of around 4 cents a share. The stock, rightly, exploded on the news, surging over 25% in the pre-market and hitting levels we haven't seen in some time. This is the narrative everyone is trading on. Tilray, the diversified holding company, is finally making its model work. But this is where we have to challenge that simple, optimistic narrative. The reality is more complex. That earnings beat was not a clean sweep, and the regulatory environment everyone is banking on is hitting roadblocks. Let's look inside that $210 million in revenue. The cannabis segment did well, up 5% to $64.5 million. The distribution segment, which is mostly their German medical cannabis distribution business, CC Pharma, was strong, up 9%. But the all-important beverage alcohol segment, the one that was supposed to be the new growth engine, was relatively flat at $55.7 million. This is the part of the business CEO Irwin Simon has staked the company's future on, spending hundreds of millions to acquire craft beer brands like Sweetwater, Montauk, and others from Anheuser-Busch. Flat revenue in their key growth category is a yellow flag. It suggests that breaking into the hyper-competitive U.S. beer market is proving just as difficult and expensive as everyone feared. This performance followed a weak Q4 of fiscal 2025, where the beverage segment actually declined, blamed for softer consumer demand and SKU rationalization. So the expectation is that beer acquisitions are fueling new growth. The reality is that segment is currently stalled. Then there is the macro picture. The entire cannabis sector has been running on the hope of U.S. federal rescheduling from Schedule 1 to Schedule 3. This is the catalyst. It would unlock favorable tax treatment under 280E, allow institutional ownership, and generally legitimize the industry. The expectation in 2024 was that this was a done deal, just waiting for the DEA to rubber stamp the HHS recommendation. The reality in late 2025 is that the process is facing unexpected delays. The administrative process is bogged down, and the hopes for congressional action, like the Safe Banking Act, are fading. It's now believed that any such reform won't pass as a standalone bill, but would have to be attached to a larger must-pass piece of legislation, which is always a political gamble. This regulatory drag is a wet blanket on the entire sector, and it forces a company like Tilray to rely on its own execution, not a legislative bailout. And as we just saw, that execution is mixed. This brings us back to the market mechanics and that failed-to-deliver spike. Let's talk about the short case. Tilray has always been a battleground stock. As of the last report, short interest was sitting around 12% of the float. That is high. Over 132 million shares are held short. Now, the bull case says those shorts are trapped. They were betting on continued losses and a failed business model, and that Q1 profit report just blew up their thesis. The massive volume we saw post-earnings, with over 300 million shares trading on October 9th, allowed many shorts to cover. You can see this in the days-to-cover ratio that fell from over 9 days back in May to just 1.6 days by the end of September, simply because the average daily volume has increased so much. But the short thesis isn't just about profits, it's about the balance sheet. Tilray still has significant debt, and its diversification strategy is expensive. The short thesis is that the beverage acquisitions won't generate enough cash flow to service that debt and fund the core cannabis operations, especially with U.S. legalization stalled. They are betting that the Q1 profit was a one-off, not a new trend. So what does that 8 million share FTD spike tell us? It can mean a few things. It can be a sign of naked short selling, where shares are sold without being borrowed. It can also be a clerical settlement failure in the back office due to the extreme volume. But given the timing, right before that explosive earnings report, it strongly suggests intense short-side pressure and perhaps a scramble to locate shares. For retail investors, this is a critical piece of data to watch. You can find short interest data directly on the NASDAQ website for free, updated twice a month. For more granular data like borrow fee rates and FTDs, you need to look at platforms like Fintel or S3 Partners. Right now, the cost to borrow TLRY shares is actually quite low, at around 2.7%. This tells us that despite the high short interest, there isn't a squeeze happening. Shares are still easy and cheap to borrow. This isn't a GameStop situation. This is a long-term fight between fundamental belief and fundamental doubt. What's your take on this? Do you see the rising short interest as smart money betting against the beer strategy, or is it just old positions waiting to be squeezed? Comment below. When you look at the stock's action today, trading at $1.50, it is bumping right up against the consensus analyst price target. This is a point of friction. Some analyst ratings from sources like Zacks have been upgraded to buy, seeing the recent profit as a turning point. But the broader consensus, looking at over 20 analysts, is still a hold, with an average price target around $1.78. The stock is currently trading in no man's land, well off its 52-week low of 35 cents, but nowhere near its 52-week high of $2.32, which it briefly touched after that earnings spike. The volume today, 28 million shares by lunchtime, is healthy. It's below 89 million share 30-day average, which is skewed by that massive earnings day, but it's strong enough to show real interest in accumulation at this level. Institutions are paying attention. The post-earnings momentum is real, but it's hitting a wall of broader sector skepticism. Let's quickly recap what Tilray Brands actually is, because the expectation is still Canadian weed stock. The reality is it's a four-part global consumer goods company. First, you have the Canadian and international cannabis business. They are a market leader in Canada and have a strong medical cannabis footprint in Europe, particularly Germany, and now expanding to places like Panama. This is the legacy business, and it's fighting for margin in a saturated Canadian market while waiting for European legalization to truly accelerate. Second, the beverage alcohol segment. This is the U.S.-focused segment, built entirely through acquisitions. This is their legal pathway into the U.S. market, giving them a distribution network and brands that could, theoretically, be used for cannabis beverages if and when federal law allows. Third, the distribution business, CC Pharma in Germany. This is a stable, profitable business that distributes pharmaceuticals, but it's low margin. It's more of a cash flow generator and a logistical backbone for their European cannabis ambitions. Fourth, the wellness segment, which includes hemp foods and CBD products. It's the smallest part of the company. The whole strategy is to use these diversified legal businesses to generate cash flow that can fund the cannabis operations until global legalization unlocks the real prize. So, what is the future outlook? The expectation is a straight line up, driven by the earnings beat and eventual U.S. rescheduling. The reality is a much bumpier road. The primary catalyst remains U.S. government action. A rescheduling to Schedule 3 would be a massive positive, solving the 280E tax problem overnight and likely causing a re-rating of the entire sector. The risk is that this continues to be delayed indefinitely, pushing the narrative into 2026 or beyond. The second catalyst is European legalization. Germany's progress is slow but steady, and Tilray is perfectly positioned there. This is a multi-year growth story. The third catalyst is the beverage segment. If Tilray can prove that it can actually grow these beer brands it bought, not just manage their decline, it would validate the entire diversification strategy. The primary risk is the opposite, that the beverage segment stagnates or shrinks, proving to be a costly distraction that burned cash without building a viable U.S. entry point. And the secondary risk is cash flow. That $265 million in cash is a good cushion, but it can be burned through quickly if the company has to keep funding losses or making more acquisitions. The battle for Tilray, trading here at $1.50, is a battle of timelines. The short sellers are betting that the company will run out of time and cash before U.S. legalization saves them. The bulls are betting that the Q1 profit is the first sign that the company's diversified model is working, that it can self-fund its growth, and that the beverage strategy will pay off, with or without cannabis. The heavy volume and the FTD spike show that this is an active war.